What's up, it's Taylor. I'm here in a jerry-rigged studio, quote unquote, aka there is a camera sitting on my chair, and I'm here for the first time in a long time to actually attempt to edit a video and speak a bit more directly about personal finance and investing. I answer a lot of personal finance and investing questions for friends. I help them work out the best possible path for them. This felt like the easiest way to kind of aggregate this across all of my different types of friends, so I'm not answering the same question 300 times. I decided to go ahead and crowdsource some common questions that people wanted the answer to. A common question I get a lot of is, how do I get started with investing? So that's what we're going to cover today. I'll start by saying I'm going to try and speak as slowly as possible. I am known for speaking way too fast. It makes it really hard to understand me in person, but way worse over video. I barely understand myself. The only issue is I might sound a little disjointed and a little out of place because my brain wants to go to the next words and I almost kind of lose my train of thought. So bear with me. I also want to put some text and stuff on screen because I'm a visual learner in case you can't keep up with my words. Hopefully that will help. That's why I pulled out a different camera, my way old one, and I'm going to attempt to use a video editing software I've never tried before because I haven't edited a video in the better part of a decade. So apologies in advance for potentially being out of focus. I can't even see myself. In the interest of enunciation, I will talk as slowly as possible. I'll give it the old college try, even though I didn't really talk slowly in college either. I am by no means a financial advisor, obviously. Disclaimer, it's for entertainment and education purposes. I'm going to cover where to invest, specifically my favorite brokerage account, which is Vanguard. I will not make you wait to find that out. I swear by Vanguard, I love Vanguard. That's a personal preference. Everyone can make their own choice. Democracy. Just kidding. This is kind of a dictatorship. I'm just talking to a camera. Very weird. This is not going to cover how to budget or how to pay off debt and when. This assumes that you have no bad debt and that you really know how to manage your own finances. You're in control of your own budget. I'm going to gloss over a lot of this because I could talk for hours, and I honestly have, but not even I like the sound of my own voice that much, so we're going to jump right into it. The reason a lot of times you might hear the phrase, don't invest any money that you need in the next 5 years, that's because the market can be really volatile. If you put your money in the peak of the crash in 2008, it would take you almost like 5 years to recover and get that amount of money back. And that's obviously a terrible case scenario, but that's the general rule of thumb, because you want to make sure you have access to liquid cash that you could need at any point. You want to keep everything in a high-yield savings account. What does that mean? That means it's going to give you an interest rate that at least hopefully keeps up with inflation. Inflation is usually around 2 to 3% a year. You are actually losing money if you just keep everything in a savings or a checkings account that doesn't get somewhere near 2%. If you want to go over the highest yield savings account, happy to chat anytime. I love Ally Bank. Yada Savings has been incredible lately. The perk of a high yield savings account is that you're not really losing money due to inflation and you have access to that cash immediately anytime that you need, penalty-free, interest-free, tax-free. It is your money, immediate access. Beyond that amount of cash, if you don't have any debt and if you're not really saving it for anything specific in the future, keep an emergency savings to cover your expenses for 6 months in the event of a job loss, and then invest the rest. That's what I do. Everything up until this point may have sounded like a lot, but it barely scratches the surface. With that said, I will jump into my own investments and how I invest. So here is how I approach my long-term investments with the bulk of my portfolio and how a lot of other people do as well based on my research. I have a set amount of cash that can go up or down depending on my goals. I always have about 6 months of expenses in a savings account that I can access anytime in the event that I lose my job. And on top of that, I also keep an extra cash reserve if I'm saving up for something, whether it's a vacation, a new computer, anything at all, I keep that extra cash reserve. Similarly, sometimes I keep a larger cash reserve in case I want to buy more stock down the line or if I want some flexibility with what the coming year will have. The first big thing to note is that there is non-retirement and retirement accounts. Retirement accounts tend to be tax advantaged. That means you pay less taxes on those, but you can't access them until retirement, which is usually legally 59 and a half years old. I have a Roth IRA, a traditional IRA, I have a 401k, and I have taxable brokerage accounts. That doesn't even cover what you are actually invested in. It is just the type of account. Regardless of the account type, you're generally going to be invested in the same thing. The only difference really is the amount of taxes that you are responsible for, not what you are invested in. For the lack of making this 923 minutes long, I will not be going into the different account types today. I will just assume they're all the same in this context. I personally use Vanguard. I love Vanguard, and I put the bulk of my portfolio into index funds. That could be an ETF index fund or a mutual fund index fund. The differences between an ETF and a mutual fund are kind of irrelevant to the layman investor, to most investors, but I will touch on that very quickly. What's up? It's Editing Taylor from the future, equally as annoying, but with messier hair. I just wanted to jump in to note that I mentioned I would be covering the similarities and the differences between them. Right now, it's just the similarities. I will use the same table to cover the differences later in the video. I just didn't plan out the whole video while I was talking to the camera. Ultimately, when you buy a share of an index fund, regardless of if it's ETF or if it's a mutual fund, you will be buying a little portion of a bunch of different companies. This automatically diversifies your portfolio. In the event that one goes under and completely loses all of their stock and asset, you still have so many others to diversify you across multiple sectors: health, tech, education, whatever it might be. The reason I buy index funds is that someone else is effectively managing those for you without having to have a financial advisor. So there's a team of algorithms, a team of people who go around and look at all the different companies and then comprise an S&P 500 index fund or a total stock market index fund with a certain allocation of those companies. Let me give you a real world example of why that is important. If I buy one share of an S&P 500 index fund, I'm buying a little piece of a bunch of different companies. Recently, Tesla actually just got added to the S&P 500. Maybe you knew that, maybe you didn't. What does that mean? That means that actually in a lot of S&P 500 index funds, you'll start to get a little piece of Tesla for every time that you buy one share of that index fund. Why does that matter? You didn't have to know that they got into the S&P 500. You did not need to know that. Someone else is taking care of all of that for you and making sure that your portfolio is rebalancing within those index funds in relation to the market. Now you may wonder, how much am I paying someone to add these different stocks for me and diversify my portfolio? Almost nothing in the case of Vanguard. It's what's called an expense ratio. It's how much are they taking to do all that rebalancing for you within that index fund. You don't actually have a financial advisor. You are just buying one share of an index fund, but you are just setting it and forgetting it. My personal favorite, or one of the most common ones in the space, has an expense ratio of 0.04. What that means is that for every $1,000 you invest, they take 40 cents. That's almost negligible. Versus a lot of financial advisors, they might take 1%, 1.5%. It starts to really eat into your gains. So now you might be asking, what do I invest in? What index fund? This is all just a bunch of words. It doesn't really make any sense. There are two very similar yet very coveted index funds in the space. They're both Vanguard. One is VT-SAX or VT-SAX, and one is VFIAX or VFIAX, however you want to pronounce it. The big difference is that VT-SAX basically has a little bit of every publicly traded stock in the US. And VFIAX is much like that of an S&P 500 index tracking fund. You're getting a piece of a pie of about 500-ish companies. So VT-SAX has a little bit more exposure. VFIAX may have a little extra growth. Kind of depends. You can't really go wrong in either way. So what did I do? I went to Vanguard and I set up an account. Now the account, again, could be an account type, TRRA, Roth IRA, taxable brokerage. But for the sake of argument, without any of that, we're just gonna go taxable brokerage today. That basically is just a normal account. You open it, you say, I wanna start trading and I wanna start investing. When you're setting up your account with Vanguard, assuming you're young and not retired, you wanna set your dividends to reinvest. A dividend is a little extra kickback that some companies provide based on their earnings and their profits. It's kind of a little, you're a shareholder, here is some. That is very different than that of the stock price increasing. Stock price increases based on the perceived value of a company and a share of that company, regardless of how well the company is actually doing in terms of profits. Massive speculative companies may be doing really, really well in the stock price, but they may not be giving a dividend. They may not be having a kickback. But with an index fund, you usually get some sort of a dividend and you want to set dividends to reinvest. When you get that little bit of a kickback, it will automatically buy more shares of that company for you. So all of a sudden, your 5 shares might be 5 shares in a quarter, and then up to 6 over years, 7, 8, 9, 10. That is how you have compound interest. Money makes you money. That money that already made you money makes you a little more money. It's kind of this weird loop. This is an example for all you visual learners out there. Up on the right, you can see a $22 payment and then a $22 purchase right after it. A $72 payment, $72 purchase. That is automatic, regardless of the stock price at that time. It's an automatic purchase, giving me more shares. When money that you didn't actually earn makes you more money, there's no feeling quite like it. You can really start to see compound interest over the years. The longer you have an account, the more you can actually see that. There's also some cool online tools that will help you model out compound interest and how that will actually impact it. The longer you're invested, the more likely you are to get some good compound interest going and crazy gains just spiraling, skyrocketing, tumbling, revolving around itself. I don't know. I'm like 8 months into a panty and I'm tired of quarantine. Then I set up that account to make an investment and I decide what I want to invest in. I can either buy VT-SAX or I can buy the ETF equivalent, which is called VTI. You might be wondering, like, well, why get an ETF versus a mutual fund? There's several differences between the two, but to any common investor, the differences are really only threefold. In an ETF, you have to buy 1 share and 1 share only. That means the minimum amount to invest is the price of 1 share. With VTI, which is the ETF equivalent of that total stock market I mentioned, VTI one share is somewhere around $190 right now. So it costs you about $190 to start investing with VTI. The other differences there's no automatic investments outside of dividends reinvesting. Don't worry about the dividends reinvesting part, that'll happen automatically, but you cannot set up your paycheck or your bank account to automatically buy a share of VTI. You also cannot buy partial shares. So if you have $200 to invest every month, you can't buy 1 and a bit of VTI. You have to only buy 1 share. That means that as it's going up and down and you only have a set dollar amount, sometimes you aren't investing it, sometimes you are, so it can be a little less than ideal in that way. But minimal barrier to entry with that starting price. With the mutual fund equivalent, the big thing there is that you can buy partial shares and you can automatically invest. You can buy 1/10 of a share if you want. The big downside to people, and that was the downside when I started out, is that there's a minimum amount to invest. The minimum is $3,000. For me, especially as a new investor, it was terrifying to put $3,000 in. So I didn't have $3,000 to invest, nor did I really want to sink all of my money into one place that I felt like I couldn't touch for a long time. So instead, I bought a few shares of VTI. Whatever amount I could scrounge up and save, I would try to save up and buy a share of VTI. Eventually, as I got more comfortable with investing and with the stock market and my knowledge there, I saved up to buy one big bulk share of VTSAX. Basically, I got several shares out of that. I spent $3,000. I was really excited about it. From then on, I never had to click to invest. I could set up automatic investments. As time goes on and you start to make a little bit more money, if you're already in the stock market and you already kind of understand how that works, it's awesome because then you are encouraged to keep your spending habits a little bit more limited because you can invest more and you can watch that grow. So every time I got a mild salary increase or an hourly rate increase, I tried to keep my expenses barely heightening, and all that extra I would just automatically turn up the auto amount that I was investing. Back from the future. I'm just gonna let most of the rest of this video ride without too much text on screen. 1, because this is new software and I'm exhausted with trying to edit this, and 2, also because it's a lot of words. I tend to use a lot of them. I'm doing it right now. If you have questions, holla. I'm in quarantine. With all of that said, that basically means what I personally did, again, not financial advice, open a Vanguard account. Roth IRA is very, very good for retirement. Taxable brokerages if you want to put more than $6,000 a year in there. The big thing that you might be asking right now is, yes, I bought these shares of VTSAX. I opened my Vanguard account. I opened a Roth IRA, or I opened a taxable brokerage, and I bought 1 share of VTI, or I bought $3,000 worth of VTSAX. What can I expect to get as a return? What can I expect to make on that investment? Now, obviously, no one knows the future. I'm definitely not a licensed financial advisor, but no one really can model the future out, right? No one could have predicted what happened this year, for example. But if we look at historicals, that is the best possible trajectory we have to look at the future. Any analyst that you ask, anyone who's looked at the stock market, will tell you that a total stock market index fund like this has returned on average 8% year over year. Some years it might be 20%, some years it might be negative 10%. But if you keep that amount of money invested for over 5 years, your average is going to be around an 8% return year over year, adjusted for inflation. So that means it's really more like 10% if it's a 2% inflation. Recently it's been more like 13%. And what that means, again, is compound interest will start to work for you the longer that you are invested. The longer you keep it in there, you will be gaining more and more money. That's the theoretical aspect, right? Based on historicals. Even if you entered the stock market with your $3,000 VTSAX investment at the height of the 2008, right when the crash was coming, you would still have recovered that money and then made more within 6 years. I do trade individual stocks out of a fund money account, but I never intend on that being my life goal. My life and my future is based on my index funds. So in conclusion, this was a lot of words. I honestly don't know how to structure this sort of thing yet. This is going to be a nightmare to edit. Yeah, it was. I really hope it's helpful. I would really like to help people with their budgets or talking to them and helping educate about finance, regardless of not being a personal finance professional. If anyone has any questions at any point, please let me know. I don't even know if any of this is working. I can't see anything. So if you have any questions, if you want to know more, if you want to do a walkthrough of how to actually invest, how to open that first account, let me know. So anyway, thanks for watching. If you made it this far, oh God, I feel sorry for your ears. I am a lot to take in, but please let me know if you need anything at all. Signing off, sayonara. Is that a rude thing to say? Deuces? Deuces. Also, if you're wondering why you should take advice from someone in sweatpants, you probably shouldn't. Bye! Duke, what was that? I'm trying to edit, bud.